Hi, everyone, and welcome. If you are self employed or run your own business, even as a side hustle, this webinar is for you. Today's daily webinar is for educational purposes. Please also shoot over any questions you might have regarding solo 401k plans, IRAs, and even the business financing 401k, aka rollover business startup 401k. And we'll pause as you ask those questions. So today's questions don't have to be specifically on today's topic. They can be regarding any facet about solo 401k plans, IRAs, or the rollover business startup 401k. So today we are diving into a powerful retirement tool that most business owners overlook. Is the solo 401k, and it could be the key to maximizing your retirement savings and cutting your taxes, all while staying in control of your investments. Okay, please also subscribe to our channel. Please like this video for more videos like this to help get the word out to other solopreneurs like yourself. So the big question is, can you get a solo 401k? That's today's topic. You might be surprised at how simple the qualifications are and how much more you can contribute compared to an IRA or a traditional 401k. And if you are a freelancer, consultant, real estate professional, medical professional, or side hustler, don't go anywhere. This plan could be a game changer. Most people think these plans are complicated or only for big businesses, but that could not be further from the truth. If you earn self-employment income and don't have any full-time employees other than your spouse or other business owners, then you probably qualify. So again, please go ahead and hit the subscribe button, give this video a thumbs up, and stick with us, because this might be the smartest retirement move you've never heard of. In this webinar walkthrough, we're going to cover the following: who qualifies for a solo 401k, how much can you contribute and potentially deduct, Roth versus pre-tax options and voluntary after-tax options, how it stacks up against SEP IRAs and traditional 401k plans, and how to open one quickly and affordably. Again, don't hesitate to shoot over any questions you might have during the live webinar. We'll pause and answer those questions as they come in. So who qualifies for a solo 401k? Well, you have to be self-employed and you have to be an owner only in the business with no full-time non-owner W-2 employees who work 1,000 hours or more. The spouse can also participate in the plan, and he or she does not have to be an owner. She just needs to be working in the business, resulting in just one solo 401k plan where both spouses work for the same business. Therefore, the plan is sponsored by the self-employed business. For example, let's say that Jack and Sally are self-employed in an LLC taxed as an S corporation. Jack is the owner of the business. Sally is not an owner, but she works for the business. She can be an owner, but she doesn't have to be an owner. She just needs to work for the business. Therefore, the LLC that's taxed as an S corporation is sponsors sponsors that solo 401k plan. So one solo 401k plan, both spouses, Jack and Sally, participate in the plan. Therefore, one fee, one plan. Jack and Sally will each have separate holding accounts under that plan to hold their respective contributions and source types, such as pre-tax, Roth, and voluntary after-tax funds. So they would have separate holding accounts, whether it's bank or brokerage accounts, under that solo 401k plan, because the solo 401k is a defined contribution plan. So again, to qualify, you cannot employ any non-owner full-time W-2 employees, with the exception of your spouse, who work 1,000 hours or more in your business. How much can you contribute and potentially deduct? Well, it depends on the cost of living arrangements each year, which is based on inflation. Those annual contribution limits go up or down depending on what's called the COLA, cost of living adjustments. For tax year 2025, the overall contribution limit is $70,000 per participant. That's the overall limit. So in my Jack and Sally example, if they both work under that same LLC taxes and S corporation, and they both want to contribute to the plan, they would each need to report W-2 wages under that LLC taxes and S corporation, and Jack and Sally's contributions to the solo 401k plan would be based on their respective W-2 wages. So for example, let's say Jack pays himself $100,000 of W-2 wages for tax year 2025. Jack is going to be able to contribute based on $100,000 of W-2 wages to the solo 401k plan. Jack can divvy up those contributions how he wishes, meaning he can make employee contributions, employer contributions, or voluntary after-tax contributions, or just voluntary after-tax solo 401k contributions. Let's say Jack wants to make employee pre-tax contributions as well as employer profit-sharing contributions. Jack could contribute $23,500 as an employee salary deferral contribution. Then he can contribute another 25% as an employer profit-sharing contribution based on $100,000, which is $25,000. You add up that $23,500 plus that $25,000. I think that equals what? $48,500. And then the difference up to $70,000, he can contribute that as a voluntary after-tax solo 401k contribution. So whatever 70,000 minus 48,500 would be the amount of voluntary after-tax contributions that Jack could make to the solo 401k plan for tax year 2025. When you add those three amounts that we just went over together, that totals $70,000, which is the overall limit. Therefore, he will have maximized his solo 401k contributions for tax year 2025. Let's do an example for Sally. Let's say Sally pays herself $70,000 of W-2 wages from that same LLC taxes and S corporation. And Sally chooses to solely make voluntary after-tax solo 401k contributions. So you can contribute the entire $70,000 as a voluntary after-tax solo 401k contribution, and then immediately convert it to the Roth solo 401k or the Roth IRA. In other words, Sally is not required to make employer contributions, even though Jack made employee and employer contributions. Sally can choose just to make voluntary after-tax contributions to the solo 401k plan. Likewise, Jack could have chose to solely make voluntary after-tax solo 401k contributions up to the overall limit of $70,000. Also, keep in mind that all contribution types, whether employee, employer, or voluntary after-tax contributions, have to be based on W-2 wages. Therefore, you have to have the necessary W-2 wages to support the contributions. We get that question quite often, especially regarding employer contributions, where individuals think that if they don't pay themselves a W-2 salary, they could still make employer contributions because the contributions are made on the employer side. That's not the case. The contributions are based on the W-2 wages. So if you don't have any W-2 wages, you cannot make any contribution type, even employer contributions. So that's a very important item to understand, because that often leads to excess contributions where individuals think that they don't have to have the necessary W-2 wages to justify that employer contribution, and they end up making contributions that don't qualify because they did not have the required W-2 wages. Okay, let's pause here. We've got a question here, and then we'll come back and pick up where we left off. Again, please subscribe to our channel. Please also join our My community. It's free to join. All are welcome. We've got over 30,000 members there. We have a lot of advisors, CPAs that post blog posts there. We have countless forums as well. And please, again, subscribe to our channel to help get the word out to other solopreneurs like yourself. So we've got a question here from Paul. Does the 70,000 limit also apply on a rollover IRA? Great question. The answer is no. Contributions and rollovers are different. When we talk about contributions, we're talking about making contributions based on your self-employment income from the self-employed business. Rollovers or transfers, those are funds that come over from funds that you already have in an IRA or a former employer plan. There's no limit in the amount that can be transferred from IRAs or former employer plans, whether 401k plans, 403bs, thrift savings plans, governmental 457b plans, 403b plans for teachers and hospital workers. There are no, and also those transfers do not impact your annual contribution limits to the solo 401k either. Good question. Again, please don't hesitate to shoot over your questions as we proceed here with our daily webinar. And we'll pause and answer those questions as they come in. So continuing with today's topic, can you get a solo 401k plan? We just talked about contribution types. We talked about how you can make employer contributions, employee contributions, and voluntary after-tax solo 401k contributions. Now you can make pre-tax contributions. When you make pre-tax contributions to a solo 401k plan, those are tax deductible, which means you reduce your taxable income for the year. Whereas if you make Roth employee contributions, those are not tax deductible, but the trade-off is that they go in on an after-tax basis to the Roth solo 401k and grow tax-free. Now you can make employer Roth solo 401k contributions and you get a tax deduction on the business side, but it's going to result in a taxable in-plan conversion on the personal side. So therefore, using the Jack and Sally example, let's say Jack wants to make an employer Roth solo 401k contribution of 25% based on 100,000 of W-2 wages. Therefore, he would make $25,000 contribution as an employer Roth solo 401k contribution. The S corporation would get a tax deduction on the 1120S, so on the business side. However, on the personal side, Jack is going to have to pay income taxes on $25,000. So it's a quirky type of rule, but Secure Act 2.0 now allows for employer Roth solo 401k contributions. And I find that it really makes sense more for an S corporation to make employer Roth solo 401k contributions because it reduces the payroll tax. However, for sole props and partnerships, it doesn't make as much sense. Okay. Looks like we've got another question here from Martin. Is it possible to roll over an existing IRA to a new solo 401k? Certainly. A solo 401k plan is often used to consolidate retirement accounts, whether IRAs or former employer plans. And that's one of the main ways these solo 401k plans are funded, in a good way to really consolidate your retirement accounts into a solo 401k plan that allows for investing in real estate, alternative investments, as well as equities. So it's a great way to really supercharge your retirement account and to really consolidate your retirement accounts. All right. Again, go ahead and keep shooting over your questions. And then we'll pause and go over those questions as they come in. In the meantime, let's get back to our topic here. Can you get a solo 401k plan? So how does it stack up against the SEP IRA and traditional 401k plans? Well, SEP IRAs only allow for employer contributions, whereas a solo 401k plan allows for not only employer contributions, but also employee contributions, as well as voluntary after-tax solo 401k contributions. So there's really no comparison, in my view, when you want to compare a SEP IRA to a solo 401k from a contribution perspective. We also find that many clients actually transfer their SEP IRAs to a solo 401k plan, because the solo 401k plan also allows for participant loans where you can borrow from your solo 401k plan. You can borrow 50% of your total balance, not to exceed 50,000, and you pay back your own 401k. You can borrow typically for a 5-year period. Payments are consist of interest and principal, which goes back to your plan, so you're paying your own plan back. If you use the proceeds of that loan to towards the purchase of your primary residence, then the loan can be extended to a 15-30-year period. So those are just some of the advantages of a solo 401k plan over a SEP IRA. From a traditional 401k, aka a full-time employer 401k, not all full-time employer 401k plans allow for voluntary after-tax solo 401k, for voluntary after-tax contributions, whereas the solo 401k plan does if you open one up with a company like my solo 401k financial. What is more, you usually cannot invest in alternative investments through a traditional 401k. Alternative investments like physical real estate, promissory notes, precious metals, trust deeds, tax liens, private equity, to name a few. So those are just some of the items to understand about the differences between a SEP IRA, a traditional 401k, and a solo 401k plan. Looks like we have another question here. So if I have, let's say, 500,000 in an existing pre-tax IRA, I can roll it into a solo 401k without hitting the contribution limit. You're exactly right, because rollovers and transfers into the plan from IRAs and former employer plans do not impact the annual contribution limits. So therefore, you can transfer any amount to the plan, whether it's $1, $1 billion, or $500,000 in your example, and you can still make annual contributions to the plan, which is the overall limit for 2025, as I mentioned earlier, $70,000. If you're age 50 or older, you can do a catch-up amount of $7,500 for a total of $77,500. There's also the super catch-up contribution resulting from Secure Act 2.0 for those who are within a certain age range, that is 60, 61, 62, or 63. If you fall within that age range, you can do a super catch-up amount of $11,250 instead of $7,500, resulting in $70,000 plus $11,250, and a total of $81,250 in contributions for those who fall within that age range and have the necessary self-employment income to justify that contribution. All right, thanks for the great questions. Again, please subscribe to our channel for more daily webinars like this. Please like our videos, as it helps to get the word out to other solopreneurs like yourself. Again, today's topic is, can you get a solo 401k? And we're almost done here. So if you have any other questions, go ahead and shoot them over here, because we're almost to the end of our webinar here. Now, as far as the topic, how do you open a solo 401k quickly? Well, we make it easy. You can open a solo 401k with my solo 401k financial by going to our online application, where we collect some information to open that solo 401k plan. Once you submit that online application, we'll draft those plan documents, provide them to you for download. You sign them, upload them, and then you reply to our next steps questionnaire, where we are informed where you want to hold the money at. You get to choose where to hold the money at, whether at your local bank, credit union, or even a big firm like Fidelity or Schwab, and we'll help you with all the paperwork. Then we'll help you with the transfers by preparing the applicable transfer forms. And then we'll be here to assist with compliance support, contribution support, whether you have questions about investments, the regulations surrounding investments, contribution rules, distribution rules, really any regulations surrounding not only solo 401ks or self-directed IRAs. Also, our solo 401k plan qualifies for the auto contribution credit, where you get a $1,500 credit dollar for dollar over 3 years. Essentially, the government is subsidizing the cost of having a solo 401k plan for years to come, and it's a total of $1,500 spread out over 3 years and $500 increments. So if you open a solo 401k plan, or if you have an existing plan with another company and you transfer it to our company, you would qualify for that $1,500 auto contribution credit, and you're not required to make contributions in order to qualify for the auto contribution credit. You just have to have a solo 401k plan from a solo 401k provider, such as my solo 401k financial, whose plan allows for it and has the necessary paperwork to support that. The auto contribution credit really didn't become available till January 1st of 2024 and after. And not all plan document providers have a plan that allows for it. Let me share my screen to provide some information on that auto contribution credit, because a lot of individuals out there are missing out. Give me a moment here while I get to that. Let's see here, give me a moment. There it is. So the way it works again is that as long as you open a solo 401k plan with a plan document provider like my solo 401k financial, you're going to qualify for the auto contribution credit. Again, these credits ultimately cover the cost of opening and maintaining a solo 401k plan, and you're not required to contribute to the solo 401k plan to qualify, and you can still contribute in whichever amount you want up to the overall limit, which is $70,000 for tax year 2025. So it's a dollar for dollar, $500. So if you open a plan, or if you have an existing plan with a competitor that you want to transfer to our company, we'll add that auto contribution credit to your plan. So you would qualify for a $500 credit for 2025, another $500 credit in 2026, and a final $500 credit in 2027, for a total of $1,500. And we'll provide you with information on how to claim that credit on your taxes. You're going to use Form 8881 to claim that credit. Also, if you are an existing client of my solo 401k financial and you opened a plan with us prior to December 31st of 2023, so before January 1st of 2024, your plan can be amended and we can add this auto contribution credit to your plan, and you would qualify for that $1,500 credit starting in 2025. So 500 in 2025, 500 in 2026, and 500 in 2027. Again, don't confuse the solo 401k auto contribution credit with other credits out there, because the other type of credits may not apply to a solo 401k, but the auto contribution credit does. So remember that. It's very important to understand the differences. Okay, let's see. It looks like we've got some more questions here before we finish up with today's webinar. So we've got a question here regarding fees. Can I use the retirement money to reimburse the enrollment and annual fees? No, you cannot use your solo 401k plan to pay the initial setup fee. Those have to be paid with business funds or personal funds. And if you think about it, it doesn't make any sense to pay with 401k funds, because the whole purpose is to grow your retirement account. You're going to be depleting your 401k if you pay with 401k funds, and that's probably why the IRS regulations do not allow for it. However, going forward, you can pay the annual fee with solo 401k funds, but I still don't recommend it because you're depleting your retirement account. It's better to pay with personal or business funds. All right, looks like we have another question here. So if I have, oh, looks like we already answered that question. Looks like we've answered all of today's questions. We've come to the end of our webinar. Again, please subscribe to our YouTube channel to help get the word out to other solopreneurs like yourself. We really appreciate you joining today's webinar. So it looks like Paul snuck in another question here. Out of the family trust in California, a solo 401 plan subject to California probate laws, or must it included in under the trust? So number one, solo 401k plans are separate from family trusts. So with the solo 401k plan, you can name a beneficiary of the solo 401k. You can name your living trust, your family trust is the beneficiary of that solo 401k. If you want to exercise control from beyond the will. So if you want to name the beneficiary of your solo 401k as someone other than your spouse, you're going to have to get consent from your spouse. Obviously, if you're not married, that doesn't matter. But as long as you name a beneficiary of the solo 401k, then it's going to flow to that named beneficiary. If you do not name a beneficiary of your solo 401k, and if you are not married, then it's going to have to go through the estate. So it's not a good idea to have those solo 401k funds flow through the estate. That's why you want to make sure you name a beneficiary. And if you're not married, then you should still name a beneficiary, especially if you have children. That way you can maybe list your living trust or family trust, and then name your children as the beneficiaries of that living trust or family trust. That way the solo 401k funds would flow to that family trust or living trust upon your death, and then they would be divvied up to those beneficiaries of that living trust. Again, check with your CPA as to whether or not it's a good idea for you to name your family trust or living trust as the primary beneficiary, or if you should just name your children as a primary beneficiary since you're not married. All right, again, thank you for joining today's daily webinar. Until next time, have a great day.